Well, good morning, friends. I hope you are in best of your health. Do take care of yourself. But then today, what we are dealing with is deductions. Well, now that you have already completed all 5 heads of income, you have already dealt with provisions relating to set off and carry forward. You are now in a position to find out the gross total income of the assessee. Now, out of this gross total income, there is a further deduction that is granted to an assessee before finding out his total income. The intent of these deductions, which are available under Chapter 6A, Chapter 6A of the Income Tax Act, is to promote certain specified activity, promote certain specified investment. What government has done is government has inserted a distinct chapter to promote certain social security scheme, insurances. In our country where we have got a huge population, it is not possible for the government to take care of each and every individual. And therefore, when you compare India to a developed nation like America, you'll find that the budgetary allocation on social security in India is not even in top 10 item. We spend more on defense, we spend more on interest. When you compare it with something like in America, you'll find that they spend more on social security, they spend more on education, they spend more on healthcare. But in India, unfortunately, because of the lovely neighbors that we've got, we spend more on defense and interest. So the outlay on defense is the biggest expenditure in case of India. Now, there should be something by which the government should be able to promote each of the individual to ensure his own security. And in order to do that, what they've done is they have provided incentive to assessees to take their own insurances, and to encourage savings, as they retire from their business or self-occupation, profession. Now, they should be in a position to earn their livelihood so that they are not dependent on the government. Now, Chapter 6A covers a whole lot of distinct sections. Section 80A of Chapter 6A provides for that every assessee, while his income is being computed, would be allowed a deduction under Section 80C to 80U. So 80C to 80U would be allowed as deduction from the gross total income of the assessee. Now, the term gross total income is not defined. However, we understand that it is the aggregate of all the heads of income. A set off would be given for losses, and thereafter whatever remains would be the gross total income. And out of the gross total income, what you get is deduction under Section 80C to 80U. Now, friends, it is not always, that you would get this deduction. There are certain special income wherein, you don't get this deduction specifically because of the provisions of those sections. We'll come to it in a short time. What 80A also says is that the deduction shall never exceed the gross total income. So if the gross total income of an assessee is zero, he, even after being eligible for deduction, he would not get any deduction under Section 80C to 80U. So that is it. What we do today is we start with some of the deduction, we solve some problems, we'll come back to 80A and the integrities of it and the nitty-gritties of 80A. For the time being, what we deal with is Section 80C. Now, Section 80C is one of the very important sections of the entire Chapter 6A. It is applicable to a whole lot of assessee, very, very pervasive. Just we'll go by the heading. So, deduction in respect of life insurance premium, deferred annuity, contribution to provident fund, subscription to certain equity shares or debentures, etc. It comes out, with a heading which covers a lot of investments done by the assessee. So whatever investment is done by the assessee, deduction would be provided if it is, made into life insurance premium, deferred annuity, contribution to provident fund, etc. See, let us go by the section. In computing the total income of the assessee, being an individual or an HUF, right? So understand, ATC is available only in case of individual or HUF. The intent is quite simple here. The intent is to provide social security. Intent is to promote investment into such instruments which provide for security of an individual or an HUF. HUF is a concept which is there only in India, but then somehow, since we are socially very connected people, and we still have the concept of family, joint family in India, hence HUF is also covered. There shall be deducted. So it says, while computing the total income of an individual or HUF alone, there shall be deducted the whole of the amount paid or deposited in the previous year. So what is paid or deposited, right? So either it should be paid or it should be deposited. Paid would mean, expenditure in a way, and deposit is something, you make it in your own account. Now this is unique. You are making a deposit in your own account and still getting a deduction. So it is not your expenditure, probably it's your investment. When you deposit something in your own account, why should you be getting a deduction? But this is something, special, promoting the deposits made by the individual or an HUF in the previous year, being aggregate of sum referred to in subsection 2. So what subsection 1 does, it sends you to subsection 2. It is asking you to go to subsection 2 to find out which sums paid or deposited would be allowed as deduction under section 80C, as does not exceed 1,50,000. So for 80C, you have got an individual limit of rupees 1,50,000. 1,50,000 rupees is the maximum limit of deduction under section 80C. We'll come to 80CCE in a short while, but then 80C standalone also gives you a limit of 1,50,000. Now subsection 2 therefore becomes important. Now we are curious to know which investments, you'll get deduction, or which deposits made, or for what you make a payment, we'll get a deduction under section 80C. Any sum paid or deposited in the previous year, being, one, to keep effect or to keep in force an insurance of life of a person specified in subsection 4. Right now, what subsection 4 says? Before going to that, any premium that you pay on life insurance policy, to keep in force that life insurance policy on life of a person specified in subsection 4. Now, look at this, life insurance is one of the very, very core areas. Any mishap can happen, and government wants to promote that each and every individual of the country should have his own life insured. So not only his own life, but what we expect is, he should also insure the life of his spouse and children, isn't it? So he should ensure life of the spouse and children. Therefore, subsection 4 covers family, which is defined in clause A of subsection 4, which means that in case of an individual, it would be individual himself, his or her spouse, and the children of the individual. Now understand, in case of HUF though, you would not have these relationships. You would have only the members. So in case of individual, it would be spouse, children, and the individual himself. And in case of HUF, it would be the members of the HUF. Right? So we call it as a 4A family. Right now, the 4A family includes individual himself, spouse, and the children. And in case of HUF, it is the member of the HUF. So whatever life insurance premium is paid by the individual on behalf of his spouse and children and for himself would be allowed as deduction under section 80C subject to a maximum of rupees 1,50,000. Now, but then there are a few conditions. What government noticed is, life insurance was being used as more of, investment rather than insurance. So what government did, there was a limit of 20%, which was already there. It was brought down to 10%. Now what this limit is all about? See, what happens with every life insurance policy that you take, there is something called as sum assured. What is this sum assured? Right? Sum assured is that amount which you would get on that policy in case of a mishap. Right? In case of a mishappening, what you get on that policy is the sum assured. Now understand, somebody takes a policy of, let's say, a sum assured of 1 lakh and he pays the premium of 1 lakh. Right? Now what is the logic in this? Would you want somebody to take a policy with a sum assured of 1 lakh and pay a premium of 1 lakh? The answer is no, absolutely no. You would not want that. Because that doesn't seem to be a contract of insurance. It is more of investment that is happening. And therefore, government came out with a limit, monetary limit, wherein they said that initially it was said that policy purchased prior to, in case of policy purchased prior to 1/4/2012, only to so much, so it would apply, ATC would apply only to so much of any premium on an insurance policy as is not in excess of 20% of the actual capital sum assured. Right? So what they are trying to suggest here is that your premium should not exceed 20% of the actual capital sum assured. Now here our sum assured was 1 lakh. What we want is, the premium, if it exceeds 20%, your deduction would be restricted to 20%. So only, to that extent, to the extent of 20% is what you're going to get a deduction in respect of policies purchased prior to 1/4/2012. But post 1/4/2012, this 20% limit was reduced to 10%. So now we've got a limit. If you take a policy today, if the capital sum assured is 1 lakh, in that case, the maximum premium that would be allowed as deduction would be 10,000 and not more than that. For policies purchased prior to 1/4/2012, it would be 20,000. So this is what was clarified, and fair enough, it is very, very logical. You shouldn't be paying too much of a premium is what, what the entire objective is, because we got to reduce it to an insurance contract rather than investment contract. So that is what was clarified. However, what happened when the provision was amended, after 31st of March 2012, that is all policies purchased from 1/4/2012, onwards, you cannot claim a deduction of more than 10% of the actual capital sum assured. Now understand, this limit is only in respect of claiming deduction. You can always pay anything more than 10%. There is no bar on it. But then you cannot claim a deduction. And I hope you've done with section 1010D. Section 1010D also clarifies this very feature, wherein they say that if you're paying more than 10% of the premium, 10% of the capital sum assured as premium, that policy would not be subjected to exemption at the time of maturity. So the entire intent again is to keep the policy as a policy, as an insurance contract. So you don't get a deduction under section 1010D as well if it is in excess of 10% of the actual capital sum assured. However, you are going to get a deduction here up to 10%. Right? So if you pay, 1 lakh is your sum assured and you pay a premium of rupees 1 lakh, what your deduction would be restricted to is 10,000. Now, if you end up paying only 8,000 for a capital sum assured of 10 lakh, you will end up with a deduction of 8,000. However, in case of people with either who have got chronic diseases or who have got disability, for them even the government realizes that there would be a higher premium because the risk involved is more. Since the risk involved is more, there would be a higher premium there. And since there is a higher premium, what they have said is, in case of whether life of a person is assured, if that person is disabled, as referred to in section 80U, or he is suffering with a disease as specified under section 80DDB. So if he's, if he has got any of the deadly diseases which are prescribed under section 80DDB, or he is a disabled person as defined under section 80U, in that case, this 10% is, increased to 15%, right? So 10% rate of premium increased to 15% of the capital sum assured. Next, so now again, the limit of 1,50,000 is applicable to all the clauses of section 80C. In fact, 80C, the deduction cannot exceed 1,50,000. We'll just check one of the, the problems here. If you could just see it on the screen. Compute the eligible deduction under section 80C for AY 2021 in respect of life insurance premium paid by Mr. Ganesh during previous year 1920. The details of which are given here under. Right, so you've got the date of issue of policy. The date of issue of policy is, in this case, it is 30th of March 2012. Understand, friends, some of you might think, why do we need to think about a policy purchased prior to 1/4/2012? The insurance contract is a long-term contract. Generally, insurance policy have got a term of 30 years, 40 years, right? At times, it's a whole life policy as well. So basically, it's a long-term contract. Since it's a long-term contract, even knowing this is actually very, very important, that a policy that has been issued prior to 1/4/2012, the premium rate is 20%, right? So 20% is what is allowed in case of policies issued prior to 2012. But then, in case of policies after that, you have to stick to 10% of the ceiling limit. So 33/2012 would mean, prior to 1/4/2012, and therefore here what is allowed is 20% of the capital sum assured. Capital sum assured, I have already explained you, you call a insurance agent and, he'll explain you everything about the policy. He's a funny guy, he'll tell you how much you are going to earn after your death. And he'll tell you that you would earn a bonus, you'll earn a return of premium. Now, this return of premium or a bonus is not included in the capital sum assured. What is capital sum assured? Simple, whatever you get on happening of a mishap under that policy, right? So if there is a mishap after you take a policy, right, after any assessee takes a policy and there is a mishap on the very next day, right, after paying the premium, and whatever you are entitled to get is your capital sum assured. So here, since it is, prior to 30th of March 2012, 20% is the limit, right? And then in case of a spouse, you realize that it is post 1/4/2012. Since it is post 1/4/2012, it is 10% of the capital sum assured. And in case of a handicapped son who's covered by section 80U disability, he is governed by the 50% ceiling. Right, so the actual sum assured is provided to us. The actual sum assured is 5 lakhs. So 5 lakhs, 20% of 5 lakh would mean a maximum insurance premium of 1 lakh. However, what he has paid is only 51,000, right? However, in the second case, when you look at this, it is 1.5 lakh rupees of capital sum assured, but he is paying for his spouse a premium of 20,000, which is in excess of 10%. So since it is in excess of 10%, only so much which is, not in excess of 10% would be allowed as a deduction. Further, 15% in case of a disabled dependent, or not dependent basically, but disabled person, member of the family, right? One who is covered by section 4A of the act, you could claim deduction in respect of that member of a family for which you are paying premium. So here, maximum allowable is 15%. However, he ends up paying 20%. So 5% is going to be disallowed. Let us have a look at the solution. Therefore, what do you think? What should be the total amount of deduction that he must be getting? Whether it should be 51,000 plus 20,000 plus 80,000? Yes, let me just go through the queries before I show you the answer result. Yes, Sai, 1,50,000 rupees is the ceiling for premium. Kristen is asking whether parents can claim deduction in respect of the individual, and whether individual also could claim. I guess what he's trying to ask is, when in case of parents, they can take an insurance for son, right? Now, whether the son and the parent, both of them can claim deduction for the same amount of premium, the answer is no. Okay, Pooja is asking, what about policies issued to disabled before 1/4/2013? With respect to disabled, yes, her observation is very correct. We've been talking of, policy purchased after 31st of March 2012. That is from 1/4/2012. The limit is, the ceiling limit is 10% of the actual capital sum assured. However, in case of disability, disabled individuals, the limit, the ceiling limit has been increased from 10% to 15% post 1/4/2013. It only means, from 1/4/2012 to 31st of March 2013, the limit for all the individual was 10%, right? Irrespective of whether they were disabled or they were not. So in that case, one special year we have got where the limit is only 10%. They realized it only after the insertion of ATC 3A, right? It was only after that they realized that people with disability need to pay higher rate of a premium, and therefore the amendment was made. So yes, we've got an answer from Janvi. Let us check it out. What she says is absolutely right. In case of self, 20% is the threshold limit. So allowable, entire amount is allowable. Right, in case of spouse, it is only 10%. So 10% of 1,50,000, that is 15,000, is allowable as deduction. Mind you, as far as 10(10)(d) is concerned, any amount received on maturity of this particular policy would not be eligible for exemption. Thereafter, handicapped son, section 80U, 15% is allowable since it is a policy purchased after 1/4/2013. What Pooja says is right. So you've got 60,000 rupees of deduction available in respect of a policy with a sum assured of 4 lakh. Right now, had he paid in respect of himself, had he paid 1,01,000, in that case the restriction would have been at the amount of rupees 1 lakh. Do you all get this? So 51,000 allowable, 15,000 allowable, and 60,000 allowable, right? A total of 1,26,000 is allowable, as against 1,51,000 that he has actually paid, right? So he would have paid anything, but we restrict it to the ceiling limit provided under section 80C of the Act. Let's move on. Therefore, so it is concerning the life insurance of the assessee. We've got one assessee himself or his family member, the spouse and the children. That's it. So it's not an extended definition of family, spouse and children, and assessee himself. In case of HUF, where the HUF pays premium for any of the members of the HUF, even that would be eligible for deduction under section 80C for life insurance premium. Thereafter, The deferred annuity contract. See what happens, as I told you earlier, it is more of, we do want some security for our residents, right? And therefore, we want them to invest into instruments which provide them periodical income. So either it could be annual income, or a monthly income. So as far as the periodical income is concerned, it would be covered by annuity, right? Annual payments. Annual payments are given by the insurance. Generally, the insurance company is the one who issues a policy for deferred annuity, and what you have is annual payment out of that policy. So whatever you pay, any premium or any amount that you pay to secure a contract of deferred annuity, that would be eligible for deduction under section 80C, provided you do not have an option to encash it. So here, all annuity schemes which pay you regular sum, only regular sum, any contribution made to such annuity schemes would be allowed as deduction. If they provide you with an option of encashment, lump sum encashment in cash, cash payment is allowed, in that case the amount of deduction would not be allowed thereafter. So this is deferred annuity scheme, with anybody, any assessee. Here there is no prescription that it should be with an insurance company, or a government scheme. It could be with anybody, any person. So next is, the item 3, sum deducted from salary payable to a government servant. Government could also, in respect of employees they secure a deferred annuity plan, and in order to make a payment of the premium, they'll deduct some amount from the salary payable to the government servant. So any sum that is deducted from salary payable to the government servant for securing deferred annuity, right, or making provisions for spouse or children, right, to the extent of 20% of salary would be allowable under section 80C, right? So maximum contribution that would be allowable as deduction here is 20% of salary, right? Not more than that. So in case of a government servant, where the government deducts the amount for securing a deferred annuity contract, an amount up to 20% of the salary would be allowed as deduction under section 80C. Salary here would mean, the basic plus DA forming part of salary, of course. Thereafter, the statutory provident fund. We've discussed three types of provident fund in case, when we were discussing salaries. So you have got the statutory provident fund and the employees provident fund, recognized provident fund and an unrecognized provident fund. So in case of, recognized provident fund or a statutory provident fund, we did see that an allowance is given, deduction is given in respect of the employee contribution. Whatever the employee contributes to such provident fund is allowable as deduction under section 80C, except for the unrecognized provident fund. So unrecognized provident fund contribution is made by the employee to such unrecognized fund is not allowable as deduction. However, statutory provident fund, which most of the government employees are subjected to, any contribution by an individual now to a statutory provident fund, here even the HUF is not covered. It is only the individuals, because employee who could be an employee cannot be a family who could be an employee, right? It is only an individual. So logically, yes, contribution made by an individual to any statutory provident fund to which Provident Funds Act apply, right? So it is the statutory provident fund. Any payment made would be deductible under section 80C. The aggregate limit, however, remains the same. Life insurance plus annuity plus the SPF taken all together, in aggregation should not exceed 1.5 lakhs. Then you've got public provident fund. Now this statutory provident fund is, applicable to an employee, or a recognized provident fund again in case of an employee. We've seen that. So both the statutory, the recognized provident fund applies only to those people who are in receipt of salary. what about the others? What about the self-employed? What about the businessmen? Do they not need security? The answer is yes, they do need security, and therefore we've got something called as the PPF, the Public Provident Fund. So any contribution made by an individual to a public provident fund set up by a government, central government, where such contribution is to an account standing in the name of person specified in subsection 4. Right. So now here, in case of self-employed, or, in case of businessman or any other person who is not in receipt of salary, or even in case where the person is in receipt of salary, he makes some additional contribution towards the PPF, that would be allowed, provided it is kept in his own name, or in case in the name of his spouse or children. Right. In case of HUF also, this deduction is available. However, the Provident Fund, Public Provident Fund rules have been amended, wherein they say that HUF would no longer be able to make any contribution or open an account under the Public Provident Fund scheme. So HUF basically are not barred by the Income Tax Act, but HUF is now barred by the Public Provident Fund scheme, right, from opening an account under that scheme. So the maximum deduction under PPF is 1,50,000. Any individual can contribute to a maximum of 1,50,000. So even the scheme doesn't allow you to make a contribution greater than 1,50,000 maximum contribution. More so, the interest that you get on this Public Provident Fund is exempt. It's not taxable under the Act. We did see section 10, 10, 11, 10, 12, right, 10, 11A. All of those sections, they provided you with an exemption in respect of interest from provident funds or the Sukanya Samriddhi scheme. We are coming to it in a short while. But for the time being, understand any contribution made to statutory provident fund, recognized provident fund, or a public provident fund by any individual, right, would be available as deduction subject to a maximum limit of 1,50,000 as provided by section 80C. Right, now that account, in case of statutory provident fund or a recognized provident fund, the account would be in the name of employee always. However, in case of public provident fund, it could be in the name of the spouse of the individual himself, or the children of the individual. That is fine. Then you've got something called as the Sukanya Samriddhi Yojana or the SSY account. Now this SSY Yojana account can be opened by an individual again, right, in the name of the individual or any other girl child. Now, as far as the scheme is concerned, it says it should be opened in the name of the girl child alone, right? So if at all there is a girl child, an individual can open an account in the name of the girl child to secure, her education. The education of that girl child got to be secured, and therefore an account is promoted, and it's it's again a flagship program of the government wherein they want Beti Bachao Beti Padhao, and as an extension of that, you have got any contribution made to Sukanya Samriddhi Yojana would be allowed as deduction under section 80C. So, or any girl child for whom such person is legal guardian. So either it should be a girl child of the individual himself or herself, or she should be a child to which the individual is acting as a legal guardian. So if that be so, any contribution made to Sukanya Samriddhi account would be eligible for deduction under section 80C. Some exemption is also given in respect of interest earned on this Sukanya Samriddhi scheme, and the exemption is provided by section 1011A. We did deal with this section when we have dealt with the exemption element. Next, the subscription to notified savings scheme, the National Savings Certificate, what you call as NSC, the 8th issue of NSC is eligible for deduction under section 80C. Now these certificates are nothing but debt, government debt. They are guaranteed by the government. The National Savings Certificate, you could just buy them. The interest on such National Savings Certificate is taxable, So interest would be remain to be taxable. Whatever you invest in National Savings Certificate alone would be eligible for deduction under Section 80C. Now, friends, understand the National Savings Certificate. In case of National Savings Certificate 8th issue, the amount of interest is also treated as investment in NSE, and therefore, interest is taxable. However, any interest that accrues, would again become investment in NSE, and therefore the interest would also be eligible for deduction. However, again, I should make a point here that the total deduction under Section 80C would never exceed 1,50,000. So interest on NSE is taxable. However, since it becomes part of the NSE, again, it is again subjected to deduction under Section 80C if at all you have not exceeded your limit. Next. So, National Savings Certificate, I hope you're getting the scheme. It is more of promoting social security for individuals and members of the HUF, right? Wherein you one contribute to life insurance premium or the provident fund or an annuity. Next is a relatively new kind of instrument, and that is ULIP, the Unit Linked Insurance Plan. Now, what is this ULIP? ULIP is a hybrid basically instrument wherein what happens is a person is buying insurance. So he not only buys insurance, but what he also does is he buys an instrument which invests into capital market. So what would happen is this particular unit linked insurance plan, you will not only get insurance, but what you'll also have is investment in capital market. So any contribution made by any person in the name of any person specified in subsection 4. Again, subsection 4 is there. So 4 would mean, the family. So an individual can contribute to a unit linked insurance plan in the name of himself or any of his family members, so spouse and children, for participating in unit linked insurance plan of UTI. Now here, this particular item X covers only the amount of contribution made to ULIP of a UTI, the Unit Trust of India, and no other insurer. However, there are subsequent clauses which covers all the insurers. ULIP contribution to a unit linked insurance plan of all the insurers is deductible under Section 80C. Right? We go to it, but for the time being, understand unit linked insurance plan of a Unit Trust of India. Then ULIP again. So we did see ULIP there. We have got ULIP again as a contribution in the name of any person specified in subsection 4 for participation in any unit linked insurance plan of LIC mutual fund, right? So LIC mutual fund issuing unit linked insurance plan, even that is subjected to deduction. Thereafter, annuity to effect or to keep in force a contract for such notified annuity plan of LIC or any other insurer, right? So notified annuity plan. What did we see here in the first clauses? We did see annuity, deferred annuity plan with any person. The second annuity item was, government securing a deferred annuity contract. And now, you've got annuity plan of which is notified by the central government in the official gazette, right, with LIC or any other insurer. So everything is covered now, annuity plan with any of the insurer which is notified by the government by way of a entry in official gazette would be available, as deduction under Section 80C. Any premium that you pay for this annuity plan would be available under 80C. Then you've got the ELSS, the Equity Linked Saving Scheme. Now this is also a modern day instrument. Well, what happens is there are a few mutual funds, which have been notified by the central government under the Equity Linked Saving Scheme of 2005. Now what this ELSS usually mean is, these are equity oriented funds which invest a large part of what they collect into equities, into the equity market. And therefore they are granted recognition by the government. The entire objective is to, promote the capital markets in India. And since the government wants to promote it, since the inclusion level into capital markets of an average Indian is quite low, ELSS comes as a wonderful tool wherein not only the person gets a tax benefit, but he gets an exposure to capital market. So as a subscription to any of the units of mutual fund covered by 1023D, or the units of the UTI fund, right, under a plan formulated in accordance with the notified scheme, right? So plan should be formulated in accordance with the equity linked savings scheme of 2005. If that is being done, you can claim deduction under section 80C of the units that you purchase of the mutual fund. Now, how do you recognize whether a fund is a ELSS? Well, every fund which is an ELSS would have, in the name itself, they would say that it is a tax saver scheme or an ELSS scheme. So if at all, you come across a mutual fund which says it is a tax saver scheme, in that case, it is nothing but eligible under this item 13 of 80C. I hope you get this. I've got a few questions. I'll just come to those questions. We'll first complete all the items. Then pensions now what we've also dealt with is some modern instrument. We've dealt with annuity. Annuity dealt with annual payments in case of an individual. There is something called a pension fund where the regularity is more frequent. So any contribution made by an individual to a pension fund, set up by a mutual fund company or a notified scheme, all pension fund individuals contributing to such pension funds would be eligible for deduction under section 80C. It should be a notified scheme although, right? So if at all it is a notified scheme, notified pension scheme, you can claim deduction under section 80C for any contribution that you make to such pension scheme. Then, now we move. So we've been dealing with, periodical payments, annual payments. We've been dealing with security. Now we've got some deposit scheme. Now here, government is giving benefit for certain deposit schemes. The reason why they're doing it is because, either the enterprise or either the undertaking which is collecting that deposit is of prime importance, or you want to promote savings of the individual. Now, the first item, that is XV, it deals with subscription to notified deposit scheme or notified pension fund set up by NHB, National Housing Bank, right? So home loan account scheme, National Housing Bank tax saving term deposit scheme, these are the scheme notified by the government in order to promote the National Housing Bank. Now, what does the National Housing Bank do? Obviously, it promotes housing in India, and we know how important is housing in India. We've got a big chunk of population here, and housing remains to be one of the priority sectors for the government, and therefore any deposit that is raised, not any but the notified deposit that is raised by NHB is eligible for deduction under section 80C. Then deposit again, so we have got deposit / pension scheme of the NHB. Deposits as a subscription to any such notified deposit scheme, again notified deposit scheme excluding NHB. Now here it does not cover NHB. A public sector company engaged in providing long-term finance for construction or purchase of houses for residential purposes. So NHB was covered, right? Now what is also covered is any public sector company providing long-term finance for construction or purchase of houses. So so something like a HUDCO, let's assume, the urban housing and urban development company. So any, they come out with they are into the business of providing long-term finance for construction or purchase of houses. they are their scheme is notified by the government for raising deposit. So if it is so notified, you could claim deduction under section 80C, right? So this is an extension of the earlier clause where first only the NHB was covered. Now it is any public sector company. Any authority constituted. Next is any authority constituted either for the purpose of dealing with and satisfying the need of housing accommodation, or for the purposes of planning, development or improvement of cities, right? So, you sense here it is, those authorities which are dealing with smart city concept, right? Planning, development of improvement of cities, towns and villages, any deposit scheme that is notified for them, right, to raise deposit from general public. Now, why would general public deposit in these schemes? Because they would get deduction under section 80C. So the entire idea is not only to promote the deposit but also to help these institutions of importance. They are important in the infrastructural growth or the growth story of the country, right? So therefore you have got deposit schemes notified specifically to promote investment in those notified schemes. Thereafter, so next is education, right? Education remains to be again an important area. Whatever tuition fee an individual pays, right? Any tuition fees that is paid by an individual, excluding any payment towards development fees or donation or payment of a similar nature to university, college, school or other educational institutions situated within India, right? So it should be situated in India. Any tuition fees that you pay to an educational institution within the country would be allowed as deduction under section 80C for the purposes of full-time education of any of the persons specified in subsection 4. Now here, subsection 4 covers a specific entry. So it is not the 4A family. Tuition fees paid only for any of the 2 children, right? Any of the 2 children. So any 2 children would be available as deduction under section 80C. What is available again here is note, it is only the tuition fees and not any other development fees or donation that you pay to the institution. Only the amount of tuition fees would be available as deduction under section 80C, and that too in respect of any 2 children. When such tuition fees is paid to a university, college, school or an other educational institution. So a lot of people come and ask me whether the tuition fees would also cover the private tuitions which my son or daughter is taking. The answer is no. So you join an institute in Kota for the JEE and you pay tuition fees there. That is not available as deduction. What is available as deduction here is only the tuition fees paid to university, college, school or any other educational institution situated within India for the purposes of full-time education of any person specified in subsection 4. So it should be a full-time education of any 2 children of the individual. Yes. So it is his choice which child to select. So a person can have 10 children, right? Any 2 of them would be covered here. Then next is residence. So housing is important. We have given benefit to those undertaking or those public sector enterprises which are dealing with which are promoting housing in India. Here the government what it does is under item 18 XV III, it says any investment that you do for the purpose of purchase or construction of residential house, right? So both either it could be purchase or construction of residential house, right? So it should be residential house property. Understand? Important here. Now house property takes into its ambit both commercial and residential. What is important here is the residential house property, and if you purchase any of the residential house property or you construct residential house property and where you make payments are made towards such purchase or construction by way of installments under any scheme of a development authority. So you're paying by installments to a development authority, housing board or other authority engaged in construction and sale of such house property, right, to purchase or construct, the residential house. So if you're doing that, if you are paying it to a development authority like a HUDCO or, any development authority of the government or a housing board, the installment paid for purchase or construction of such residential house property would be available as deduction under section 80C, right? So, but then again, the maximum limit is 1,50,000. Any installment or part payment of the amount due to any company or cooperative society of which assesses the shareholder or member towards the cost of house property allotted to him. So whatever is paid by way of an installment of part payment by a shareholder for acquisition of the share, by virtue of which that shareholder would get, the beneficial interest in the residential house property, would be eligible for deduction under section 80C. Now what would happen? Either you're not going to the development authority or you're not buying a particular unit in a cooperative society, or it does not come by way of an installment from a cooperative society. What you do is, instead of paying installment to the authorities or anybody else, what you do is you borrow the amount. So you borrow, and with this borrowing, you purchase or construct a residential house. Now, even that is eligible, right? Any borrowing that you make for purchase or construction of residential house property, and that borrowing, you repay. Once you repay, the repayment of that borrowing would be eligible for deduction under section 80C. So installments that you pay towards loan taken for purchase or construction of a residential house property is also eligible for deduction under section 80C. Let us check it out. Repayment of amount borrowed. So repayment of amount borrowed by an assessee from central or state government. So it covers central, state government, banks, including cooperative banks. So it would cover, loan taken from bank, loan taken from LIC, NHB, public company in India with the main object of providing long-term finance for construction of house. So something like a HDFC, right? It's a public company engaged in providing long-term finance for construction or purchase of houses. A company in which public are substantially interested, or a cooperative society where such company or society is engaged in financing of construction of houses. Assessee, employer. So any loan taken from the employer of the assessee, right, even that would qualify, the repayment would qualify under section 80C. It's the repayment of loan, right, which is, now repayment of loan, would have two elements. One is the principal amount and the other is the interest amount. Now, the principal amount is the interest amount is already deducted under section 24B. So no further deduction would be available in respect of the amount of interest. What you could claim under section 80C is only the principal amount repaid for a loan taken for the purposes of construction or purchase of the residential house, and not the interest amount. So any loan taken from employer would also be eligible. Employer, where such employer is the authority, board or corporation or any other body established or constituted under central or state act. So generally the government bodies, the assessee employer if it is a public company. So both the employees are covered, both the government employer and the public company or a university or a college. So employer being a college or a university, or a cooperative society, giving loan to the employee, any repayment done by the employee to the employer for the loan that he has borrowed from employer in respect of construction or purchase of residential house would be eligible for deduction under section 80C. So do you get it? So it is, the principal amount in installment, right? The principal amount of installment that is eligible here you could understand this. The principal amount. The interest is already claimed as deduction under 24B. So we are not giving any further deduction. What is available here is the principal amount, subject to a maximum of aggregate limit of 1,50,000. Thereafter, so you don't just pay the installments. What you also pay is the cost towards purchase of such residential house. You make some payment of stamp duty. So it is the incidental expenses for purchase, the stamp duty, the registration fee, right? Every purchase of immobile property got to be registered with the sub-registrar's office, right? So that registration fee or the stamp duty paid on transfer would also be eligible for deduction under section 80C. So it is not just the cost of the residential house, but it is also the cost, the incidental cost that you require on transfer of that property. So stamp duty, registration fee or any other expense for the purposes of transfer of such house property to the assessee would be available as deduction under section 80C. So whenever you come across, a problem wherein the assessee have bought a house, this could be merged with a problem on house property, wherein you come to know that he has purchased a house, and once he has purchased a house, you not only claim deduction under section 24B in respect of interest on borrowed capital, but you also claim deduction under section 80C in respect of the stamp duty, registration fee and the principal amount repaid by such assessee. So you've got to take care of it. This might not come as a separate problem, but it could come up by way of an adjustment. Therefore, you have to be careful while you deal with a problem on house property or the computation of the total income. Then, but shall not include any payment. So what it shall not include, right? So you are buying a residential house, you pay installments included, right? The principal amount is included. The stamp duty, registration fee and other transfer expenses included, but it shall not include. What it shall not include? It shall not include the admission fee, the cost of share and initial deposit. So any admission fee that you pay to the cooperative housing society, right? You buy a flat in a housing society, they have got something called as an admission fee, or they ask you to deposit some security deposit, some amount by way of a security deposit. That is not available as deduction under section 80C. Further, you are not buying or, constructing a new house property, but you are only renovating the existing property. So any addition, alteration, repairs of an existing property after the completion certificate is being issued, that is not covered by section 80C. The entire idea is to promote new housing rather than, the existing one. Existing one who has already got a house and is only renovating it, would get no deduction under section 80C. Although interest on borrowed capital for such renovation, alteration, etc. is available as deduction, but deduction under 80C would not be available. Then any expenditure in respect of which deduction is allowable under section 24. We have already discussed this. So interest is already allowable as deduction under section 24B. So you're not going to claim deduction again under section 80C. Fair enough. Isn't it? Double deduction is something you're not going to, you're not going to enjoy double deduction. Thereafter, equity. So we have discussed, residence, we've discussed deposits, we've discussed pension, annuity. Let's move on to equity. As subscription to approved equity shares. Now, what are these approved equity shares? Again, of a public financial institution or a public company. These approvals are given in respect of only those public companies or public financial institutions which are engaged in, infrastructural development of the country. 80IA4 is the section which was, which has seen a sunset now. But then it was in respect of infrastructural development, telecom infrastructure. Right? So more of that. Any company engaged in infrastructural development of the country and issuing equity shares were being approved, right? So any subscription to such approved equity shares of or debentures, so not just the shares but also the debentures. So either you go by equity or by debt of a public company or an eligible issue of capital by public financial institution is available as deduction under section XIX. Thereafter, units of approved mutual fund units, approved units of mutual fund. If the fund is utilized for eligible issue of capital of any of the company which is engaged in infrastructural development, right? So again, it is approved units, right? So only if the scheme is approved by the government, then you get a deduction under section 80C. But essentially, not a lot of instruments have been approved under these clauses. What you must understand here is 80C covers a lot of deductions, lot of item of deductions. But then the focus area is, the basic items like the life insurance premium, or, the annuity contribution to an annuity plan or a pension plan, or the residence. So these are the clauses which are relevant for all kinds of assessee, and every now and then you require to invoke these clauses of 80C. So go by the general requirements of the assessee, understand all the normal clauses in detail. You could remember these, and when it comes into a problem in a paper, you'll instantaneously understand that the information given would be it is approved equity share, right? So if it is approved equity shares, you understand that it is eligible for 80C. Then deposit as term deposit. So again, we've got deposits, long-term deposits made by assessee. Now this is to encourage saving of an individual, right, for a fixed period of not less than 5 years. So 5 years is the lock-in period for this deposit. You cannot withdraw it before 5 years with a scheduled bank, right? So all those banks which are notified into the second schedule of the RBI Act, those banks are called as scheduled banks. Any term deposit kept with them in a scheme notified for a period of 5 years, right? So again, there is a different deposit scheme which have been notified, and it should be framed according to the guidelines laid by under the Income Tax Act. If that is so, any contribution or any deposit made to such term deposit account with a scheduled bank would be eligible for deduction under section 80C. So scheduled bank, is important here. You keep a deposit with non-scheduled bank, non-scheduled bank would not get a approval at the first instance, and that is not eligible under section 80C. What is eligible is only scheduled bank in accordance with the notified scheme. Then bonds as subscription to notified bonds issued by National Bank for Agriculture and Rural Development. So NABARD, National Bank for Agricultural and Rural Development, but nothing but NABARD. So any bonds which have been issued by NABARD would be eligible for deduction under section 80C. The Senior Citizen Savings Scheme, any amount that you paid to the Senior Citizen Savings Scheme, so it could be a savings account or a deposit account under the SCSS. Whatever you contribute under the SCSS would be eligible for deduction under section 80C. Now, ideally, if you read the name itself, you'll understand that this is only for the senior citizens, right? Individuals being senior citizen of 60 or greater than 60 years of age, right? So it is not available to every individual, but only to senior citizens who deposit their money in the SCSS. If they are depositing it in the SCSS, they could claim deduction under section 80C for any deposit they make under the SCSS. Again, here the lock-in period is that of 5 years. Thereafter, post office time deposit scheme. So POD, right? So POD of 5 years. Again, 5 years time deposit. SCSS also, the the minimum time you got to keep the deposit is for 5 years. In case of POD also, the post office deposit scheme, the time deposit should be kept for 5 years. So the lock-in period of 5 years is prescribed under the Act for such term deposits. You could see the term deposit kept with scheduled bank was 5 years. Again, SCSS, I tell you, is 5 years. I'll show, as we proceed further, what happens if we, withdraw it before 5 years. In case of post office time deposit, again, the period is that of 5 years. So long-term deposits basically. Then pension. Being employee of a central government, so employees of central government alone, as a contribution to specified account of a pension scheme under section 80 CC/D. So what we are talking here is of NPS, the National Pension Scheme. So whatever an employee contributes, an employee of a central government contributes to the NPS, his own contribution would be eligible for deduction under section 80C. We'll come to what if the central government contributes on behalf of the employee. Now if the central government contributes on behalf of the employee, we've already seen this while we discussed salary, but then understand what are the two kinds of contribution. Contribution to the NPS is by the employee himself and probably a matching contribution by the employer. Right. Now as far as the employee is concerned, it is already tax paid, but then deduction is available under section 80C, right? In case of employer contribution, it is governed by 80CC/D, right? Whatever the employer contributes is first made part of salary. If you remember, we dealt with NPS in section 17. Whatever the employer is paying would form part of salary. Rest of it, once it goes into the calculation of salary, once it goes into the calculation of gross total income, thereafter deduction is available under section 80CC/D. Now this 80CC/D deduction is subject to certain terms and conditions. We'll come to it, but understand whatever the employer contributes to the NPS is first made taxable and thereafter a deduction is available under section 80CC/D. As far as the employee contribution is concerned, it is covered by section 80C. Some of it is also covered by 80CC/D. We check 80CC/D for NPS. For the timing, understand if the employee is the employee of central government, in that case any contribution made by him towards the pension scheme is available under section 80C if such pension scheme, if such amount is kept for a fixed period of not less than 3 years and in accordance with the notified scheme, right? So if he does that, it is available as deduction under section 80C. Now sometimes what happens, a person would be inclined, what he'll do is he'll make an investment in life insurance and thereafter he would cancel the policy. He'll claim deduction and he'll cancel the policy. Now that is not the intent. The intent is to provide the assessee, that security. So if he cancels the policy, he shouldn't be eligible for the benefit. Similarly, a deposit is kept for 5 years and he he prematures the deposit. Again, that is not the objective, and therefore what they say is you'll have to reverse the benefits that you have claimed if at all, you premature it, or you break it before a particular time. There is a lock-in period provided, distinct lock-in period for each kind of instrument. And if you break it before that lock-in period, you will have to forego the benefits that you have already claimed. So subsection 5 of 80C, it deals with termination of contract of insurance. So if at all, you terminate the contract of insurance within 2 years. So minimum 2 years, you have to keep the contract going. If you terminate it or you don't pay the premium at all, and it gets terminated automatically within a period of 2 years after the date of commencement of the insurance, right? So for 2 years at least you should keep the policy live. If you terminate it prior to 2 years, you are not going to get deduction of the premium paid on such policy. So premium paid could be, what you could do here is, see, insurance policy could be taken in year 1. The moment the policy is taken, you have a look at the policy. There is some lookup period for the policy. 30 days time is provided to you. If you don't like the terms and condition, what you could do is cancel the policy. Now you paid the premium and thereafter what you did is cancel it. Now if you cancel the policy, the premium paid would not be available as deduction. What could happen? You take the policy in the current year, but you don't pay the premium for the subsequent year. For the year 2, you do not pay any premium. In that case, it is terminated automatically by the insurance company. Now, if it is so terminated, the claim that you made in first year would be deemed as your income in the year in which the policy is cancelled. Right. So within 2 years after the date of commencement of the insurance, or in other cases before premium have been paid for 2 years. Right. So a single premium policy, you pay only one time, and therefore in the second year you would not have any liability to make a payment of any insurance, but you still cancel it. So if you cancel it, the entire premium that you have paid in year 1 would be deemed as your income of the year 2. That is the year in which you cancel the policy. Do you get this, friends? Everyone? Now, if in case of unit linked insurance plan, I did share with you the ULIPs. ULIPs are hybrid plans, plans which have got both the best of insurance and, mutual funds. They invest into capital market. So it is a hybrid of, mutual fund, equity oriented mutual fund and insurance. It provides you both. And therefore unit linked insurance plan, in case of unit linked insurance plan, you've got a period of 5 years, a minimum lock-in of 5 years. So if you do not revive the policy, or if you don't pay the premium for 5 years, this was earlier, it was 3 years, a couple of years ago, now extended to 5 years. If you terminate the policy, a unit linked insurance plan within a period of 5 years, or don't revive it, it would, the amount that you have claimed as deduction under section 80C for such unit linked insurance plan would be taxable, right? Would become taxable in the year in which, the failure occurs, where the failure to pay occurs. Thereafter, transfers house property. If at all a person buys a house property, we say that you could claim, deduction in respect of repayment of principal amount under section 80C, the cost associated with that purchase, under 80C. But then what if the person buys it and sells it again, and what is the point in giving the benefit of 80C then? So what they say is that you should not sell the house for 5 years. For 5 years, minimum login period of 5 years from the end of the financial year. So it is from the end of the financial year in which possession for such property is obtained. So possession of the property could be obtained mid of the year, but it says end of the financial year in which possession is obtained. After that 5 years. So let's assume, somebody gets a possession in July 13. He cannot, July 2013, he cannot sell the house, it would be post 31st of March 2014. So that is the end of the financial year. After this, 5 years. So up to 31st of March 19, you would not be able to sell the house property that you have bought and claim benefit under section 80C. Right. So 5 years of lock-in is provided from the end of the financial year in which possession is obtained. Then, so in such cases, you do not claim any deduction for the previous year itself. So let's assume, you have a ULIP, you pay premium for first year, second year, but in the third year, you do not pay the premium. So if you do not pay the premium, the previous 2 years, the benefit that you have claimed under 80C would have to be reversed in the third year itself. However, it could happen that you take a policy in the first year, and in the first year itself you make the premium but you cancel it again and claim a refund of the premium. In that case, in the previous year also you are not eligible for any of the deduction. the aggregate amount of deductions so allowed in respect of the previous year or the year preceding the previous year shall be deemed to be the income. Look at this. If you do not follow the terms and conditions of the investment, it shall be deemed to be the income of the assessee of such previous year and shall be liable to tax in the assessment year relevant to such previous year in which the infringement occurs. Right? So deemed to be your income. Do you get this, friends? Again, in case of SCSS and the time deposit of, time deposit with the post office deposit, time deposit, if they are withdrawn within a period of 5 years, the deposit would be deemed to be the income. What the amount of deposit which is claimed as deduction would be deemed to be the income of the assessee in the year in which it is withdrawn. I've discussed this before. However, in case of SCSS, what happens is, in case of senior citizens savings scheme, the senior citizen has got a risk, he because of the age he may die, and therefore, keeping that into mind, they have said that provided that amount liable to tax shall not include the following amounts. One, interest which is already included in the total income. The interest is always taxable, so whatever you withdraw from SCSS is not going to be taxed. Or any amount received by a nominee or a legal heir of the assessee. So on death of such senior citizen, after the death, any amount that is received by the nominee or the legal heir, other than the interest accrued, the principal amount for which the senior citizen have claimed deduction under section 80C, and now the legal heir is getting that amount. Now it would not be income in the hands of the legal heir or the nominee. It would be income only in the hands of the senior citizen. So that has been clarified by way of a proviso there, that the amount shall not include, the amount which the legal heir receives on the death of the assessee. So this is 80C for you all. I hope you get it, friends. I'll take up some questions. What you do is you take a break of 5 minutes by the time I'm going through the questions, and we'll come back again. Well, friends, we do have some interesting questions here. The last one is from Ronit, who is asking, sir, what if the child of an individual is major, earning income as salary, but still premium is paid by the individual? Well, there is no condition that, the child should be dependent or independent. Whatever it is, a parent could claim deduction in respect of any premium paid for the child or the spouse. So no question as far as dependent children, right? It is allowable. Ronit, I hope it clarifies your doubt. Then yes, whether subscription towards notified equity and debentures would have a lock-in period of 3 years. Yes, it would have a lock-in period of 3 years by virtue of section 80C subsection 6. Right, there is a lock-in period of 3 years, and if at all you transfer, sell any of the equity or the debentures, right, within a period of 3 years, it would be taxed in the year of such transfer. You're right. Then there is an additional account in NPS. Pooja is asking whether there is an additional account in NPS and what does it mean. Yes, NPS covers two kinds of account, tier 1 and tier 2 account. We come to it in a short while we discussed 80CCD. Then Komal is asking whether step marking is given. Well, contentious, Yes, it should be given ideally. Well, it depends on the paper checker. But yes, if more or less it is correct, step marking is given. What will come under other educational institution? Well, other educational institution would mean any institution which gives you some vocational degree or, degree recognized by UGC, Institute of Chartered Accountants of India. The tuition fees that you make a payment towards would be other educational institution and available for 80C. Then, Karan is asking whether tuition fee should be mentioned separately. The answer is no, tuition fee shouldn't be mentioned separately. There is no such requirement under the Act. But what it has said is that deduction would be available only in respect of tuition fee, not development fee or donation that you make to a particular educational institution. What is not allowable is development fee and donations, etc. But to my mind, tuition fee would include all other fees by whatever name you call it. Then, ULIP from ICICI Prudential, yes, it is available as deduction. Annuity plan of LIC, okay. Not get Shaikat, your question is not, I cannot understand it. Anyways, Mansha is asking a very good question. If assessee is a resident or a resident but not ordinarily a resident, and he buys a insurance plan of UK, would he be eligible for deduction under section 80C? Now it's an interesting question. To my mind, yes, he would be eligible for deduction under section 80C. Insurance policy could be, bought from anybody across the world. Whatever insurance, whatever premium you pay for such insurance, obtaining such insurance would be available as deduction. Then, is the limit of 1,50,000 applicable to EPF and Sukanya Samriddhi Yojana? Yes, it is applicable to all EPF, Sukanya Samriddhi Yojana or PPF account. The aggregate limit for all of the clauses that we have gone through under section 80C should not exceed 1,50,000. So you may end up paying 10 lakh rupees, but the total amount, it would be 1,50,000 in aggregate for all the clauses that we have seen until now. Let's move therefore now. Next is 80CCC. Deduction in respect of contribution to pension fund. So what you make a contribution is towards pension fund. Again, we did discuss pension fund above. Now here you've got certain pension funds which are not notified under 80C but 80CCC. So these pension funds, whatever amount is contributed to pension fund would which are approved under 80CCC, either it could be an annuity plan of LIC of India or any other insurer, right? the contribution made to such annuity plan or the pension fund set up by LIC or other insurer would be available as deduction under section 80 triple C. Basically what happened is, we have devised now a policy of EET. What is this EET? EET would mean exempt at the time of making investment. So deduction is given to you at the time of making investment. Exempt during the continuation of the investment. When you are contributing and there is some interest accruing on that investment, it would be still exempt. But it would be taxable in the year of withdrawal. So the model is EET. Earlier it was like EEE. There are certain investment opportunities where you have got a EEE kind of framework, exempt. So life insurance premium paid on a policy, exempt, deductible at the time of making the payment of the period. It would remain exempt during the continuation of the policy. And when you receive the amount, again it would be exempt under section 1010D, right? Subject to conditions, of course. But there are certain investments which are exempt at the time of making those investments. By exempt, what I mean is deductible. It would be the income therefrom would be exempt during the continuation, but would be taxable at the end when you withdraw the amount. And 80CCC is such an investment wherein you make a contribution to pension fund or an annuity fund. Deduction is available under section 80 triple C. Again, here the limit is 1.5 lakh rupees, maximum permissible limit for all the investments under 80CCC, right, would be and 80CCD1, right. We'll come to it in a short while, but would the maximum capping is 1,50,000. Here it is made to a pension fund. It is exempt at the time of it is deductible. The amount you make contribute to the pension fund is deductible. However, when the pension is paid to you, that amount is going to be taxed in the hands of the assessee. So deduction is allowed at the time of making payments, but taxable at the time of receiving it. For this purpose, the interest and bonus accrued credited shall not be reckoned as contribution. Contribution is your own contribution. Any bonus that accrues would not become contribution. When any amount paid or deposited have been taken into account for the purposes of this section as a deduction under section 80C shall not be allowed. So you're not claiming deduction both under 80CC and 80C together. Generally, the policy, the pension policy or the annuity plan would make a specific note on whether the policy is, approved under 80C or 80CCC. The plan would, reading the policy document, you'll understand that it is a plan covered under section 80 triple C. The maximum permissible deduction is rupees 1,50,000. Whether the overall limit is 1,50,000 under section 80 triple C. So you have got an individual limit as well as an overall limit. Individual limit for 80C was also 1,50,000. For 80CCC also individual limit is 1,50,000. All taken together is also restricted to 1,50,000. Where any amount standing to the credit of the assessee in the fund for which a deduction have been allowed together with interest on bonus is received by an assessee. So is received by an assessee or his nominee on account of surrender of such annuity plan. So if you surrender the plan, look at this, it would become taxable in the year in which such surrender happens, or in which you withdraw the amount on that annuity plan. So again, the pension is also taxable. Periodical payment of pension out of the annual plan, out of the annuity or the pension fund is taxable. Let's move on to 80CCD. CCD here is not cafe coffee day. So, pension scheme of central government. What happened is earlier the central government was incurring a lot of expenditure on pension, and therefore from 2004, that is the previous NDA government, it was NDA in power at that point in time, they brought in a new pension scheme. And they said both the employer and the employee are going to, contribute to the pension scheme, and the pension scheme is going to pay to the employee after retirement the amount of pension. Government is not going to pay it. We are going to contribute today. Let the pension scheme pay the amount of pension, because ultimately it comes very hard on the central government to make payment of pension of a retired employee, probably who is not adding value to the government, but then the amount of pension is a big outlay for the government, and therefore they started up with a new pension policy. And the new in accordingly, they started contributing 10% of the salary every month towards the pension account. 10% of salary was contributed towards the pension account under the NPS, and a matching contribution was made by the government. Government contributing 10%, employee contributing 10%, and the amount of such contribution made by the government was taxable in the hands of the employee under section 17. But then taxability arose. There has to be something. Pension is an important item of, which is beneficial to the assessee. It is a welfare measure basically, wherein the employer gives to the employee in his hard time back a periodical payment. Now, if it is a welfare measure, there should be some deduction which should be available. You need not tax it. The idea was not to tax it, but reduction was provided even for the employer contribution. Employee contribution we have already seen is covered by 80C. Employer contribution was covered by 80CCD, right? So 10% contributed by the employee, 10% contributed by the employer, right? Employee contribution was always taxable, but then deduction was provided under 80C, and the employer contribution, which was taxable, the deduction is provided under section 80CCD. The benefit of this scheme is also available. So it is not just the government employee, but also the individuals employed with other employers. So it is also available for other employers as well as the government being an employer. Section 80CCD provides for deduction in respect of contribution made to pension fund notified by the central government. So basically, NPS came into being, and the central government notified Atal Pension Yojana as the pension scheme. Contribution made to such scheme would be eligible for deduction under section 80CCD, because it was that previous government which had come up with the entire concept of this pension plan. Therefore, Atal Pension Yojana. Quantum of deduction under section 80CCD1. So we've got different subsections here. We've got 80CCD1, which provides for deduction of amount paid or deposited by an employee in his pension account, subject to a maximum of 10% of salary. So again, either he claims deduction under section 80C. 80C, it is available only to a government employee. Mind you, it is not available to any other employee. However, here under section 80CCD1, the employee contribution is available as deduction under section 80CCD1, subject to 10% of his salary, and deduction in respect of self-employed individuals. So even if an individual is self-employed, he can make a contribution to the pension fund subject to 20% of GTI, right? So 20% of gross total income is the maximum limit under section 80CCD1. However, 80CCD1 is covered in the consolidated limit provided by 80CCE, right? So when the consolidated limit is 80CCE, the maximum deduction would not exceed 1,50,000. Right, it is not to exceed 1,50,000. Maximum deduction available for all 80C, 80CCC and 80CCD1 would be 1,50,000 as per section 80CCE. Right. So 80CCD1, subsection 1 of 80CCD provides for the deduction in respect of employee contribution, which is not already claimed under 80C. So an individual employed by central government, 10% of salary, an individual employed by any other assessee, again 10% of salary. However, a self-employed individual, in his case, it is 20% of GTI because he would not have salary and therefore 20% of gross total income is available as deduction. Then comes the very important 80CCD 1B, right? Now this is, one of the section which gives added benefit to an assessee. So, by this time that 80CCE restricts my deduction to 1,50,000. However, 80CCD1B is not covered by section 80CCE and therefore the restriction of 1,50,000 is not applicable to this clause. Now what this clause covers? It provides for an additional deduction. So, it is an additional deduction that is provided up to rupees 50,000 in respect of whole of the amount paid or deposited by an individual assessee under NPS, whether or not any deduction is allowable under section 80CCD. So, additional deposit that an individual makes by virtue of his contribution. So, it is the employee's contribution or the self-employed person's contribution. Under the NPS, it would be allowed as deduction to a maximum of 50,000. Such additional deduction got to be made in the tier 1 account of the employee or the self-employed individual. Now this 50,000 additional contribution is not subjected to limit of 80CCC and therefore the total deduction under section 80C, CCC and CCD could become 2 lakh rupees therefore, right, because of this 1B being out of 80CCE. So where the deduction under section 80CCD1 is subject to overall limit of 1,50,000, 1B it is not subjected to the overall limit. Now the employer's contribution. We have talked of the employee contribution in 1 and 1B. The employer's contribution is governed by 2. Right, subsection 2 of 80CCD, contribution made by central government or any other employer is allowable as deduction in computing the total income of the assessee. Now, not all the employer contribution is available as deduction. They say any contribution in excess of 10% of salary would not be available as deduction. However, in case of government, in case of central government, they have prescribed a 14% limit. So, 14% of salary, up to 14% of salary deductible under section 80CCD2. Now this subsection 2 is also not covered by 80CCE. So employer contribution is also not subjected to the limit of 1,50,000. In addition to 1,50,000, you get a deduction for employer contribution subject to the condition that such contribution is 14% of salary in case of government employee, and in case of central government employee, it is only central government, and in other cases, it is 10% of salary. So I hope you get 80CCD. As I told you earlier, the limit of 80CCE is not applicable, to 80CCD2. It does not apply. No deduction will be allowed under section 80C in respect of amount paid or deposited by the assessee under 80CCD1 or 1B. So in order to claim double deduction, that goes as a thumb rule, nothing much to be explained there. Now what happens during the closure of the account? Again, this is a kind of an EET investment, right? At the end of it, it is going to be taxable. The amount of pension that the employee receives or the self-employed receives would be taxable in the hands of the employee. Fair enough, pension is always taxable and it is part of salary. We have seen it into the definition of salary. It is going to be taxable. However, at times what assessee does, he goes for a lump sum payment of pension. So if you close the account or you opt out of the scheme and you receive a lump sum payment, that is going to be taxed in your hands, right, at the time of receipt. The amount standing to the credit of the assessee in the pension fund along with accretion of to such account, would, if in the year of receipt by the assessee, or in the year of in the year in which it is received by the assessee or nominee of the assessee on account of closure, on account of opting out of the scheme, right? On account of conversion of the pension plan into an annuity plan. Sometimes what the assessee does is he converts the pension fund into an annuity plan. So even that would be covered. However, there is a bit of an exemption, a relief provided. So not everything is taxable. Although, provisions are made to make it taxable, but then it is subject to certain terms and conditions. Not everything is taxable. In case of death, right? In case of death of an assessee, now the assessee has died, the nominee is receiving this amount. Now in case of nominee, you cannot tax it as pension. In the hands of nominee, it would never be pension, and therefore any amount received by nominee on death of the assessee, right, on closure of the account or opting out of the said scheme would not be taxable in the hands of the nominee. Further, assessee shall be deemed not to have received any amount in the previous year if the amount is used for purchasing of the annuity plan. So if you close the NPS account and shift to an annuity plan, now this is mere convenience of the employee. He wants to shift from pension to annuity. That is fine, you're not to tax it just because of the conversion. So they have specifically clarified that it would not be deemed to have been received if it is merely conversion of NPS to annuity plan and the proceeds of NPS are used for purchase of an annuity plan. Then, however, having said all of this, there is a exemption provided under section 1012A. And in section 1012A, any amount that you receive from a national pension scheme trust, to the extent it does not exceed 60% of the amount payable, right? So 60%, to the extent of the 60% of the value, 60% of the value, of the fund that is there would not be taxable, right? It would be exempt. So irrespective of what 80 CCD says, it would be exempt. It would not be taxable, but it would be exempt under section 1012A of the Act. Then 1012B, which says to provide relief to an employee subscribing to NPS under the pension scheme on partial withdrawal or the pension scheme provided under 80 CCD, partial withdrawal made out of the fund, as per the regulations made, shall be exempt to the extent it does not exceed 25% of the contribution. See here, as far as 12A is concerned, it deals with closure of the account or opting out. So it is one time thing. Either you close the account, claim 60% exemption, 40% you pay tax on, right? In case of where the assessee is not closing the account, but what he does is he only wants to withdraw for some, there could be some emergency that happens. He doesn't want to close it, but he wants to withdraw part of it. So up to 25% of withdrawal, right, would not be taxed under 1012B. So if the withdrawals exceed 25%, it is going to be taxed. However, if the withdrawals do not exceed 25%, it would be exempt under section 1012B. Now, only that amount in excess of 25% would be taxable. Then, so 80CCE I have already dealt with. What is not covered by 80CCE does not cover 80CCD 1B and 80CCD subsection 2. So these two items are not covered by the limit of 80CCE. Let me take up a few questions, then we move to 80D. Well, is there a clarification in respect of dependent and independent? I guess Priyanka is asking about
the dependent or independent children? Well, there is no clarification. The only thing that is provided in subsection 4 of section 80C is that family would include, the spouse, individual and the children. So they've not had the intention been to, provide deduction only in respect of dependent children. They would have categorically said that. What they've said is, policy can be taken in respect of individual himself or the spouse or any of the children. That's it. Then, so we have, in a nutshell, we have got all the ceilings. 80C, it is 1.5 lakh rupees. 80CCC, again, it is 1.5 lakh rupees. 80CCD 1, it is 10% of salary or 20% of GTI. GTI in case of self-employed, salary in case of employee of a government or company, private employer. Both of them are covered. Then 80CCE, we've got a consolidated limit of 1,50,000. 1B is an additional contribution to NPS subject to a maximum of 50,000. Subsection 2 of CCD, in case of government employer, 14% of salary. In case of other employer, it is 10% of salary. Let's check up a problem. Here you've got basic salary of Mr. A is 1 lakh per month. So he is entitled to dearness allowance of which is 40% of basic, right? So he's got 1 lakh rupees of salary per month, and what he gets is 40%. That is 1 lakh. It is 1 lakh. 1 lakh rupees of salary, and he is entitled to a dearness allowance of 40% of basic salary. That is 40,000 rupees per month is dearness allowance, but only 50%, only 50% of it is forming part of retirement benefit. What it says is only 50% of the salary is going to form part of the retirement benefit. Both Mr. A and his employer, ABC Limited, contributes 15% of the basic salary. Now look at this, when we talk of 10% of salary, it means basic plus DA. However, here what Mr. A and the employer is contributing is 15% of mere basic salary. So don't come to a conclusion that 5% of it would be taxable or would not be deductible, right? Just wait and, calculate the salary, take 10% of basic plus DA, and thereafter only you could conclude what is the amount taxable. Right. So ABC Limited his employer ABC Limited contribute 15% of salary to the pension scheme referred to in section 80CCD. Explain the tax treatment in the hands of Mr. A. Now understand his own contribution since he's a private sector employee. You could realize that he's a private sector employee. ABC Limited is a private company, not government. Since it's private, he would be governed by 80CCD 1, subsection 1 in case of his own contribution. So his own contribution would go under subsection 1 of 80CCD. The employer's contribution would go under subsection 2 of 80CCD. Any additional contribution would go under 1B, subsection 1B of 80CCD. So let us check it out, let us check the answer. So as far as the employer's contribution is concerned, it is 15% of basic. Now basic is 1 lakh rupees per month, so 12 lakh rupees per annum. 15% of 12 lakh is 1,80,000. What the employer has contributed? 1,80,000. Right. Now What the employee has contributed? Again 1,80,000. Both the employer and the employee, both of them have contributed 1,80,000 rupees each. As far as Mr. A's contribution is concerned, it is again, it is always taxed as salary. Employee's contribution is first taxed as salary. Only thereafter you get a deduction. As far as the employer's contribution under NPS is concerned, again it is also taxed as salary. Thereafter a deduction is provided. Salary here would mean basic plus dearness allowance. So first and the foremost thing we'll have to calculate salary. So salary would be basic plus dearness allowance forming part of salary, and we already know that not the entire dearness allowance is forming part of salary, but only 50%, right? So out of the 40,000, only 20,000 rupees is forming part of salary, right? So therefore salary for the purposes of calculating deduction under 80CCD would be basic plus the DA, that is 2,40,000, 20,000 rupees into 12, that is 2,40,000. So my total salary is 14,40,000. See, I have received more than this. I have received 4,80,000 rupees of DA, but only 2,40,000 rupees forms part of retirement benefit, or forms part of the contract, and therefore salary for the purposes of 80CCD would be 14,40,000. 10% of such salary would be 1,44,000. So, you shouldn't be moved into, taking 10% of 12 lakhs and taxing the rest of the 5%. You're not to do that. What you must do is add up both the salary and the DA forming part of retirement benefit, and 10% of such amount would be deductible. So deduction under section 80CCD 1 is restricted. Now 1 covers employee's contribution. I did explain you. It is employee's contribution which is covered by 80CCD 1. So 1,44,000 rupees of deduction. As far as 1B is concerned, he has made a contribution of 1,80,000. Now 1 would cover only contribution to the extent of 10%. Now understand this very carefully. He has contributed, employee has contributed 1,80,000. Out of that, 1,44,000 is available under subsection 1. The remaining amount, that is the difference between 1,80,000 and 1,44,000, would be available under section 1B. Right, under subsection 1B of 80CCD, because that is the additional contribution of the employee, right? Since it did not exceed 50,000 rupees, the entire amount would be available as deduction. Now, had it been, 2,10,000, in that case, this would have been restricted to 50,000 only. But then, since it is, the difference between 1,44,000 and 1,80,000 is lesser than 50,000, what you do is you claim the entire amount as deduction under section 1B. You have another way of looking at it. What you can do is you can, claim a deduction of entire 50,000 out of 180. You claim a deduction of 50,000 under subsection 1B, and rest of the 1,30,000 you claim as deduction under subsection 1 of the Act. So it would be lesser than 10% in that case. So even then, you could claim the entire amount of 1,80,000 as deduction under the 2 subsections of 80CCD. Then, as far as the employer's contribution is concerned, it is governed by subsection 2. And only a deduction of 1,44,000 rupees would be available. 36,000 rupees is already included in the amount of salary, so you don't have to tax it again. 36,000 is not to be taxed again. It is already included in the amount of salary, right? What you'll have to do is you'll have to claim a deduction of 1,44,000. 1,44,000 is allowable as deduction under 80CCD 1. This would be subjected to overall limit of 1,50,000 under 80CCE. However, 36,000 would be available under 1 B. Then I have discussed this alternative with you. What you can do is you could claim under 1B, you could claim 50,000 rupees, and under CCD 1, you can claim the rest 1,30,000 rupees. Employer contribution, I have discussed with you, 10% of salary, that is 1,44,000 rupees. So my amount of deduction under 80CCD2 is going to be restricted to 1,44,000. Remaining 36,000 is going to be automatically taxed because it is already included under section 17(1) VIII. So that brings me to the end of 80CCD here. I hope you got it. Let us move ahead, therefore. See your next problem. Gross total income of Mr. X for AY 2021 is 8 lakh rupees. He makes the following investments or payments. So it is investment or payments during the financial year 1920. Contribution to PPF, Public Provident Fund, in his own name or name of wife or children, allowable as deduction under section 80C to the extent of 1,10,000. Fair enough. One maximum amount that could be invested in a PPF account of one person is 1,50,000. Same is the limit in case of Sukanya Samriddhi Yojana. 1,50,000 maximum amount of investment that you could make in a year. Right? So 1,10,000 is below 150. Thereafter, payment of tuition fee in some school of New Delhi. Education for his son studying in class 11. So it's a full-time education which he is taking up, 45,000 rupees, and only in case of one child he is taking it. Fair enough, 2 children is allowed. So 45,000 allowable as deduction. Repayment of housing loan taken from Standard Chartered. Now this repayment, if the information is given, when the repayment breakup is given to you, principal amount, let's say 20,000. Now 5,000 is interest amount. In that case, you're going to take only the principal amount. Here nothing is given to us. We assume that it is principal amount. Contribution to approved pension fund of LIC. Right? Approved pension fund of LIC is governed by 80CCC. Right? So that is going to be allowed as deduction again. There is a consolidated limit of 1,50,000 for all these payments. So what is the amount of deduction that you could claim under section 80C? PPF 1,10,000, below 150 allowable, 45,000 for this and 25,000 for repayment of housing loan. Tuition fees 45,000, PPF 1,10,000 and housing loan 25,000. The total amount of payments made is 1,80,000. However, it has to be restricted to 1,50,000. I told you approved pension fund 80CCC again 1,05,000. So see, it is first restricted as per 80C here. Thereafter, 80CCD never exceeded 1,50,000. The total of payments made therefore is 255, but again it would be restricted. All of this would be restricted as per 80CCE. So there are multiple restrictions, multiple level of restrictions here. So the total deduction would never exceed 1,50,000, except for when it comes under subclause 1B and subclause 2 of 80CCD. Let's move on to the next concept, and that is deduction in respect of health insurance premium. Now again, understand health insurance premium is one of the important things which the government wants to promote, because it only reduces their burden. The health cost, the cost of healthcare is the largest to the government. Now one of the largest costs. Although they do not allocate those many funds in the budget for healthcare. When you look at the developed countries across the world, they would spend more on the healthcare. You would have heard about Obamacare. More and more allocation was done towards healthcare in a country like US, but a country like India, there is not much of a thrust or not much of an outlay over the healthcare of an individual, and therefore incentive is provided to an individual or an HUF to take an health insurance policy. So whatever premium that a person, that an individual or HUF pays on a health insurance policy would be allowed as deduction in addition to a few more of the items. Let us see what it is, what it provides. There shall be a deduction, there shall be deducted such sum specified in subsection 2 or 3. So what is allowed as deduction here is, sum specified in subsection 2 or 3. So what essentially subsection 1 does, it sends us to subsection 2 and 3. Subsection 2 deals with individual, subsection 3 deals with HUF. By payment of which is made by a mode specified in 2B. So they say that the payment should be made by a specified mode only. If you are making payment by any mode, that is not, we are not going to allow the deduction. You have to make the payment by way of a specified mode. Now specified mode is otherwise than by way of cash. Right, so you not to pay cash except for preventive healthcare checkup. We'll come to it, but you don't have to pay this medical premium in cash. That's the only condition attached. In the previous year, out of his income chargeable to tax. So he should make a payment out of the income chargeable to tax. So no deduction out of an exempt income, and payment should be made of those expenditure which is provided in subsection 2 and 3. Now what subsection 2 says? Subsection 2 says in case of individual, the whole of the amount paid for insurance of health. So that is nothing but health insurance premium. Whatever you pay towards as a premium towards health insurance for assessee or for assessee or his family. So he is paying both, for the family or the assessee himself. Now here, it is the extended definition of family. We check it out, but for the time being understand, assessee or his family, he pays insurance premium or makes a contribution to notified central government health scheme. So he could contribute into CGHS, right? So either he makes a payment of insurance premium, or he contributes to the central government health scheme, or he makes a payment towards preventive health checkup, right? So now this is a recent addition. Earlier it was only premium on health insurance, but then government realized that a stitch in a time could save the nine, and therefore timely preventive healthcare checkup is equally important. So they provided for even payments made for preventive healthcare checkup to be availed as deduction by the assessee. Being an individual, it is also available for HUFs. Right? So individual or HUF spending anything on to preventive healthcare checkup or insurance premium on health insurance or contribution to CGHS would be allowed as deduction under section 80D as it does not exceed an aggregate. So all three of them taken together should not exceed 25,000. Right? So maximum deduction under subsection 2A would be 25,000. Let it unravel. I know some of you would have read about it, and in case of senior citizen, an additional 25,000 rupees is available. We'll come to it. Gradually understand how it unravels. First, individual for health insurance, number 1. Number 2, contribution to CGHS. Number 3, preventive health checkup. All three taken together, maximum deduction of 25,000. And so now it is like assessee or his family and an insurance on health of parents, right? So it is not only his family, so spouse and children, and also the parents. Health insurance of parents of the assessee. So he pays premium for parent, available as deduction. He pays premium for himself, deduction is available. For preventive health checkup of parent of assessee, so both preventive healthcare checkup is available. Assessee himself, his family, or his parents, he does a preventive healthcare checkup. He gets, for parents, he gets a separate limit of 25,000. So now you have got a limit of 25,000 for assessee himself and his family and for his parents. So a total of 50,000 is available, until we read this. So until section 80D subsection 2, we have got a deduction of 50,000. How it is being broken up? Amount paid for assessee and his family and amount paid for parents of the assessee. Next is the C and the D clauses of subsection 2. Right now, the first two clauses dealt with the insurance premium paid, right, or the preventive health checkup done, or the central government health scheme contribution thereof, right? However, sometimes what happens is a person is not at all covered. A person may not be covered by an health insurance policy. Maybe because of the age he is into, no company is willing to give him health insurance because, health insurance is a business and if they perceive there is a lot of risk because of the age of the person, they may not give medical health insurance policy to such a person. In that case, he cannot pay medical health insurance premium, but what he does is, he'll have to make the medical expenditure. So even if a person is making medical expenditure on, assessee himself or any member of his family, as it does not exceed 50,000 rupees. So 50,000 rupees of medical expenditure is allowed as deduction in the hands of the individual, provided he has incurred that expenditure. So medical expenditure should have been incurred on the health of the assessee or any other member. You have got insurance premium paid up to the limit of 25,000. Here you have got an additional claim for medical expenditure, right? Medical expenditure actually incurred up to rupees 50,000. Or, so either he could incur the medical expenditure in case of assessee himself or any of his parents. For parents, you have got a separate limit. So you have got a limit of 50,000 of medical expenditure for assessee himself and his family member, and parent of the assessee, the expenditure that is made for the parent of the assessee to the extent of 50,000 rupees. However, these two, the medical expenditure comes with condition. Now the conditions are provided in the first provisos. Let's see what it says. C and D is available only in case of senior citizen. So it is not available to everybody. I told earlier, medical expenditure would be incurred by the individual probably because, out of compulsion, he is not being given policy by any company. So when generally the health insurance companies don't give the policy, it is in case of a senior citizen. So if a person is a senior citizen, that is of the age of 60 years, at any time during the current previous year, he is supposed to be a senior citizen. Once a person is a senior citizen and any expenditure is done on medical treatment of such senior citizen, being assessee himself or his spouse or any other children or any other parent, right? So both C and D is applicable only to assessees who are, only to members of the household or the assessee being a senior citizen, and no amount has been paid to keep in force an insurance on health. So you cannot pay the insurance on health, and therefore what you have done is you have incurred the medical expenditure. Now, since you have not claimed any deduction in respect of health insurance of that particular person, what we give is, a deduction for medical expenditure under section 80D, subject to a maximum of rupees 50,000. Now understand, both for C and D it is senior citizen and therefore the limit is 50,000. Quite logical. We'll come, you'll understand the logic as it unravels further. So for C and D you have got a limit of 50,000 and the condition is, the assessee or the member of the family or the parent should be a senior citizen and you should not have paid any insurance premium, medical insurance premium. In case of, second provision provides for conditions for both clauses A and B and C and D. It says the aggregate of sum specified in clause A and C. Now, what A and C covers? See, A and C is going to cover insurance of health of assessee or his family, and C covers medical expenditure of assessee or any member of his family. So both of them, cover the same thing. Both A and C cover the same class of assessee. Both taken together. See here, 50,000 rupees is available here, 25,000 rupees is available here. If a particular assessee incurs 75,000 rupees, the maximum deduction that he could claim under both A and C taken together would be 50,000 rupees. That is what is stated in the second provision. So A and C and the aggregate amount referred to in B and D. B and D covers, clause B and D covers parents. So maximum deduction for A and C or B and D would be 50,000. So maximum deduction, taking everything into account cannot exceed 1 lakh rupees. For parents it would be 50,000, and for assessee or any of his family members it would be 50,000. Now this expenditure could be either insurance or it could be the medical expenditure, the actual expenses. Now there is subsection 2A which provides for a limit on preventive healthcare checkup. It says that the entire amount of preventive healthcare checkup for parents and the assessee himself or the any other family member shall not exceed 5,000 rupees. So maximum, preventive healthcare checkup that you could claim under this particular section is rupees 5,000 only. And that is, this 5,000 is a part of the consolidated limit of 50,000, right? So, or 1 lakh as the case may be, you cannot exceed that limit of 25,000. So it is part of 25,000 as well, right? So that 25,000, and there is a sublimit of 5,000 in case of a preventive healthcare checkup. So as far as the mode is provided, we did discuss, subsection 1. Subsection 1 dealt with the mode of payment, and the mode of payment in case of preventive healthcare checkup. Since it is a small amount, 5,000 rupees is the only amount, and therefore in case of preventive healthcare checkup, it can be any mode, including cash. However, in case of all other expenditure, the payment should be made other than cash, right? So it could be paid by credit card, debit card, account level transfer, anything but not cash. So if you're making a premium payment in cash, that is not available as deduction under section 80D. But if you're making preventive healthcare checkup payment in cash, that is available because the maximum deduction is 5,000. So they realize it's a small amount, and therefore, you can pay in cash. In case of an HUF, you don't have the parent. In case of individual, you had parent and the family members and the assessee himself. In case of HUF, it is only the members of the HUF, right? So you don't have any separate limit for parent. It is members of the HUF. Same insurance of health, 25,000, and medical insurance, medical expenditure of member, it is 50,000. 50,000 for any other member. Then condition for B is, B is in case of medical expenditure. Medical expenditure could be claimed as deduction only in case of member who is a senior citizen and there is no insurance policy of such senior citizen member. In case of A and B, the total amount shall not exceed rupees 50,000. There is no separate clause for parent because HUF cannot have parent. Then comes 80D subsection 4 and it increases the limit. When it comes down to medical insurance premium, the logic is, with a smaller age, the health risks are less. And when the health risks are less, the premium amount is also less. But as the person becomes older, the risk of, the claim increases, and therefore what the insurance company do is they keep on increasing the premium. So in case of senior citizen, the premium could be always about 25,000, and therefore what they have done is, in case of a senior citizen, the limit of 25,000 is substituted by 50,000, right? So wherever you read 25,000, it is 50,000 in case of a senior citizen. As far as clause C and D of subsection 2 is concerned, right, in case of individual where expenditure was done on medical treatment of a person, right, you would remember that it covers only senior citizen, right? It covers only senior citizen. In case of HUF also we have seen this, medical treatment covers only the senior citizen, and therefore a flat limit of 50,000 is provided, right? In any case, when insurance premium is paid for a senior citizen, the limit is 50,000. Then, where the amount specified in clause A or clause B of subsection 2, that is in case of, the individual and his parents and the family members, where a lump sum payment is made. See what happens at times. You're not interested in paying the premium amount every year, right? So what you do is you pay for the entire 5 years period, right? So I generally pay premium for 3 years upfront. Now when you pay it for 3 years upfront, the Act has made a provision wherein they say that you should claim it on a pro rata basis, right? So you've got to claim it over a period of 3 years. So whenever you pay it, pro rata basis, the amount would be available as deduction under section 80D. In the previous year for insurance of health for more than a year. So when you make a lump sum payment, right? So 2 years or 3 years or, more than a year, it would be allowed in appropriate fraction. Now that appropriate fraction is nothing but pro rata basis. A pro rata yearly basis, right? So 3 years, it would be divided in 3 previous years, including the first year in which you make the payment and subsequent years. Let's take up a problem and understand this. Mr. A, aged 40 years, paid medical insurance premium of rupees 20,000 during 1920 to insure his health as well as health of his spouse. So both the spouse as well as, his own health. Now both of them are covered. He also paid medical insurance premium of 47,000 during the year to ensure the health of his father. Right now, father is a senior citizen. You could understand, he's 63 years of age, more than 60. So who is not dependent on him? Again, did we read that the parent should be a dependent parent? We did not read anything like this, and therefore, this becomes immaterial. He contributed rupees 3,600 to central government health scheme during the year. Now he pays 20,000 towards premium and 3,600 towards central government health scheme. Both of them would be allowed. He had incurred 3,000 in preventive healthcare checkup for himself and the spouse, and 4,000 by check. So whether he pays by cash or by check in respect of preventive healthcare checkup doesn't matter. The total deduction shall not exceed, 5,000 of his father. Compute the deduction allowable under section 80D. So you're just to compute the amount of deduction that you claim under. So in case of, self and spouse. In case of self and spouse, see the actual amount of payment. Insurance premium, 20,000 rupees is paid. Central government health scheme, 3,600 rupees is paid. And preventive healthcare checkup, 3,000 rupees is paid. Total, total payments under subsection 2, A covers 26,600. Now this has to be restricted to 25,000 because the individual himself or the spouse is not a senior citizen. Had it been a case of a senior citizen, it would have been extended to 50,000. But then here, since they are not senior citizens and they have paid more than 25,000, it would be restricted to 25,000. So I claim deduction in respect of Insurance, in respect of capital gain, in respect of central government health scheme, and preventive healthcare checkup. The total amount is 25,000. This 3,000 would be restricted to 1,400 because it makes the total cap of 25,000. Thereafter, we need to find out the amount of, the premium paid in respect of father. Now, in case of father, he has paid 47,000 rupees of premium. We read it earlier. Now, since father is a senior citizen, this 47,000 rupees would entirely be allowed as deduction. Why? Because 25,000 is substituted by 50,000 in case of a senior citizen. So let's check out, as far as the father is concerned, the total deduction under B1 and 2 above shall not exceed 50,000 rupees. It would never exceed 50,000 rupees, but 50,000 rupees would be available as deduction. Let's check it out. See here, premium paid in respect of father who is a senior citizen, 47,000 rupees entirely allowed. Preventive healthcare checkup, it was 4,000 rupees. Total payment 51,000. 47,000 rupees plus 4,000. Look at this. We do have it, in case of himself, he had spent 3,000 rupees. In case of father, the preventive healthcare checkup was rupees 4,000. 4,000 plus 47,000 is 51,000, but you got to restrict it to 50,000. Now, this preventive healthcare checkup is restricted to 3,000. See, how much did he, claim in respect of self and his spouse? He claimed 1,400 rupees towards preventive healthcare checkup. How much is he claiming in case of father? In case of father, he is claiming 3,000 rupees towards preventive healthcare checkup. The total amount is 3,000 plus 1,400. That is 4,400, which is less than 5,000, and therefore allowable. Right? So the sub-limit would not apply here just because it is well below 5,000. The allowable expenditure is well below 5,000. So in case of total deduction allowed on expenditure of preventive healthcare checkup, self, spouse and father is 4,400. That is 1,400 in his own case and 3,000 in case of father, so which is within the maximum permissible limit. So do you get this, friends? Any questions? Rakshana is asking that ATCCE is a little confusing. Well, Rakshana, try and read it once again, with the flow of the lecture. I'm sure you'll understand it. There are three components to it, employee contribution, employee's additional contribution, and the employer's contribution. As far as the employer's contribution is concerned, it is covered by subsection 2. As far as the additional contribution is concerned, it is covered by 1B of CCD. And the employee's normal contribution is covered by subsection 1. The normal contribution falls within the limit of 1,50,000. However, the additional contribution and the contribution of the employer towards the pension fund is not covered by the limit of 1,50,000 under CCE. It's quite logical. You just go through it once again, and if you have got a specific query, do ask me. I'll try and help you out. So I hope you get this. As far as the healthcare checkup is concerned, the preventive healthcare checkup, the total limit is 5,000. The claim is below 5,000 because of the restriction. The overall restriction is 25,000 in case of Vatsasi because he is not a senior citizen, and in case of father who is a senior citizen, the limit is 50,000. So it is restricted to 50,000 and 25,000. The total deduction is 75,000 under 80D. I hope you get this. Let us move ahead. Now, next is Why aged 40 paid medical insurance premium of rupees 22,000 during the previous year 1920 to ensure his health as well as health of his spouse and dependent children, right? He also paid medical insurance premium of 33,000 during the year to ensure the health of his mother, age 67, who is not a dependent on him. He incurred medical expenditure of rupees 20,000 on his father, right? Who aged 71 years, who is not covered. So look at this. He has got a father who is not covered by Mediclaim policy. Since he is not covered by Mediclaim policy, he gets even this expenditure within a limit of 50,000 rupees. The consolidated limit for both parents would never exceed 50,000 rupees, right? So total payment of premium for mother is 33,000 plus 20,000, that is 53,000 rupees is the total expenditure, restricted to 50,000 only. His father is also not a dependent upon him. He contributes 6,000 to central government health scheme, right? Compute the allowable deduction. Let us find out the allowable deduction under section 80D therefore. Well, quite simple. There is not much of a complexity here. He could claim in his own case 25,000 rupees of deduction. He has paid, premium of 22,000 and plus 6,000 rupees. In case of mother, he has paid premium of 33,000 and expenditure of 20,000. In case of father, who doesn't have a policy and he's a senior citizen. So 75,000 rupees again in case of an individual who pays for himself, spouse, dependent children and parents, right? So parents, one of the parent is, understand here, one of the parent is covered by medical insurance and the other is not covered, right? Both of them are senior citizen. The consolidated limit therefore is 50,000 rupees. If the premium here in case of mother would not have been 33,000, but it would have been, let's assume, it would have been 15,000. In that case, 15 plus 20, 35,000 alone would have been allowable as deduction. However, here mother is claiming, mother is senior citizen, paying, you are paying premium for her, 33,000 rupees entirely would be available as deduction. You pay medical expenditure, again that is available as deduction in case of a senior citizen not covered by medical insurance. Total is 53,000, restricted to 50,000. If in the problem it is given that he pays medical premium in case of mother of 33,000 and he also incurs medical expenditure of 20,000 in case of mother who's covered by insurance, whether it would be available, the answer is no. The medical expenditure then would not be available. Medical expenditure is available only in case of senior citizens who are not covered by health policy, right? Let's move ahead therefore. Now section 80DD, deduction in respect of maintenance including medical treatment of a dependent disabled, right? So we have done 80D. We dealt with mediclaim policy or the health insurance policy or the medical treatment expenditure. Now here we have got disabled dependent, right? DD, disabled, D for disabled and D for dependent. So I guess you'll remember this. Disabled dependent, 80DD. 80DD provides deduction to an assessee who is a resident in India, being an individual or HUF. So available only to individuals and HUF and only who are residents in India. So if you are not resident in India, you're not claiming deduction. Non-residents cannot claim it. Whether he's a ordinarily resident or a not ordinarily resident, again would not matter. What matters here is that he should be a resident in India and the assessee should be an individual or an HUF who makes, expenditure on medical treatment of a disabled dependent, right? So what, now disability is something, which is distinct from disease. Disability can be by birth or acquired disability. It could be neurological disorder or something like that. only those assessee who have got dependents who are disabled, right, who have got some permanent disability, and that individual or an HUF is incurring medical expenditure for training, rehabilitation, right, including nursing, whatever kind of medical expenditure on training or rehabilitation of a disabled, right, of a person who is disabled, can claim deduction under section 80 DD. Right now, either he could incur a medical expenditure or training expenditure, rehabilitation of such disabled dependent, or what he can do is he can take a policy for such disabled dependent for a secure future of such disabled dependent, and makes a contribution to a policy of a life insurance corporation or other insurer, right, in for the maintenance of dependent, in just in case, since the disabled person is dependent on the assessee, and if there is a mishappening with the assessee himself, there is nobody to look after the dependent, and therefore for the maintenance of dependent, the assessee takes the insurance policy. If he contributes, if he makes any payment towards such insurance policy or the medical treatment, it would he would be entitled to a deduction under section 80 DD. Right now, what happens? The maximum deduction is 75,000 in case of if the dependent disabled is not suffering with a severe disability. If he is suffering with severe disability, the deduction would be 1,25,000. If he is suffering with non-severe disability, the deduction would be 75,000. Now understand, the deduction would apply even if the assessee incurs 1 rupee. Right? It is not necessary that he should incur 75,000 rupees entirely. Even if he makes some payment, right? If any amount, it says if any amount is incurred, right, for medical treatment, or if any amount is paid to to the scheme of a life insurance corporation or other insurer for maintenance of the dependent, he can claim deduction of 75,000 rupees in case of a dependent disabled who is not got severe disability, or 1,25,000 in case of severe disability. Right? Do you get this, friends? The scheme should provide for payment of annuity or a lump sum in event of death of the individual or member of the HUF. So what happens is it is governed by the death of the assessee. Right? If there is a death of the assessee who has taken policy for the disabled dependent, the policy would mature as soon as there is a death of the assessee. Or alternatively, it could also mature when there is a death of the disabled dependent. So either ways, in case if it is the assessee who dies, whatever amount that the dependent receives under that policy, would be exempt. So that would not be taxable. However, whatever amount is received by the assessee after the death of the disabled dependent, that is not covered by section 1010D, and it would be taxable. Right? So the benefit of deduction under this section is also available to assessee incurring expenditure on maintenance, including medical treatment of persons suffering from autism, cerebral palsy, and multiple such diseases. Right? So what you could do is claim 80DD in case you are making actual expenditure on maintenance of a person who is disabled. Right? If that person is severely disabled, you get a deduction of 1,25,000. If the person is not severely disabled, you get a deduction of 75,000. For claiming deduction, what the assessee has to do, the assessee has to furnish a certificate of a civil surgeon that yes, indeed the disabled is dependent, and in case if the disability is reversible, we will have to take a periodical certificate. What happens if the person dependent predeceases? The amount deposited paid would be chargeable in the hands of the assessee. We have already talked about it. Now, dependent here is Now here it is the concept of dependent, right? So independent, if the person is independent, he would claim deduction under 80U, not under this section. Here we talk of independent spouse, children, parent, brother, sister, of an individual who is wholly or mainly dependent on such individual and not claim deduction under section 80U of the Act. So if he is dependent, the relative is dependent, he can claim deduction under section 80. If he is independent, he would have his own sources of income, and since the disabled person has got his own sources of income, he can claim deduction under section 80U. We'll come to it, right, as we proceed further. However, a person who is disabled and dependent on the assessee, he would never have a source of income, a credible source of income. So wholly or mainly dependent on the assessee, in that case the assessee can claim deduction under section 80DD for such dependent relative being spouse, children, parents, brother or sister. The extended definition again. In case of HUF also, a member who is wholly or mainly dependent on such HUF. Now see here we have a problem. Mr. X is a resident individual. He deposits a sum of rupees 50,000 with LIC every year for maintenance of handicapped grandfather. Now look at this. We have seen the dependent definition, and it does not cover grandfather, right? It covers spouse, children, parent, brother or sister. So it is not grandfather who's covered, right? Father can cover grandfather, but not grandson. Grandson cannot cover grandfather. So it would not be allowed as deduction, although he is, dependent and disabled. Both the conditions are satisfied, but he is not a dependent relative. The disability is one which comes under fine. A copy of certificate is also provided, but not covered. Since he is not covered, nothing would be available as deduction. What if it was handicapped father? In case if it was handicapped father and he was dependent on the assessee, he could have claimed the deduction of how much? 50,000 or 75,000. You incur any amount of expenditure. If he is severely disabled, he can claim 1,25,000 rupees. If he is not severely disabled, he can claim 75,000 rupees. So flat deduction of 75,000 irrespective of the amount of expenditure. Do remember this, there could be an adjustment for 80DD and you go by the number here. So you don't have to go by the number of amount of expenditure incurred. It is a flat 75,000 or 1,25,000 as the case may be, which is available as deduction under section 80DD. I hope you get section 80DD. So, that brings me to the end of the lecture today. We cover all other sections tomorrow. Tomorrow will be a little cryptic and a little fast. I have got only one lecture to complete all the deductions. We have got some deductions to cover. I hope you understood the very important 80C, 80D and the 80DD. 80C and 80D are all pervasive. Since they are so pervasive, you've got to understand each of them in detail. You try and, read yourself as well. 80CCD, I could see there is a problem, there is a bit of confusion which the students have. Just go through the lecture again. Just try and read your module. You'll understand what 80CCD is all about. In case if you've got any query, do post it tomorrow and I'll try to take it in the live batch. But then for the time being, we end for today and we take up all the rest of the sections tomorrow. Thank you so much, friends. I hope you enjoyed. We continue tomorrow.